updated trading rules. There have been some minor changes recently and some more profound ones from longer ago. Well, some basics, and that is you can either buy or sell stuff in either order, by the way, and you might want to buy it when it's rising or falling, or vice versa in the case of selling. If you buy first, then sell, that's called going long. And you can sell first, then buy back later, hoping the price drops. That's called going short. These are available in all instruments except mutual funds. Here we should pause to differentiate between these investments, which are vehicles, literally, figuratively, and the shelters in which they're placed. Here's a graphic. The shelters are the types of accounts, typically IRA, both kinds, pension funds, cash account, and the vehicles typically are stocks, bonds, mutual funds. And this update is reflecting now something called T1, meaning settlement for most items must be within a day, either money's going in or money's coming out. Notable exception are options. That's immediate cash settlement. Noting while there are other markets in the world, the U.S. markets are timed from New York. Well, for those in the West Coast, that means it opens at 6:30 a.m., 9:30 in New York, and 1 p.m., 4 p.m. in New York. And there's a bit of extra time for something on ETF options. Let's start with stocks. They could be also preferreds, and something called ETFs. Those are exchange-traded funds, and that allows mutual funds to trade as stocks for reasons we will see later, and that is you can't place special types of orders. Stocks will usually have a 1 to 3 letter trading symbol, often a mnemonic, if they are traded on organized exchanges like the New York and American exchanges. Often they'll have a 5-letter symbol if they're traded on the NASDAQ, which is an over-the-counter. Now, preferred stocks, warrants, they may have a special symbol, and it may be proprietary dependent. Stocks are priced in pennies. It used to be eighths, but that's a while back. And a standard number of units of trade is 100, called a lot. Now, you can do multiples, odd lot trading, but it turns out when we see options, that 100 turns out to be important. The value is 1 to 1 here, and they do settle now with that T1 rule in 1 day. You can borrow often 50%. Sometimes the rules are more strict during crises or whatever. And as we will see later, you get to use those trading rules, which include stops and limits. Here's a shortcut. Limits you love, stops you hate. Meaning limits are at a better price, stops are at a worse price, with the latter being thought of as either cutting your way in front of the line or trying to get out in front of everybody in a burning building. Options are an instrument which can, and in fact often is, risky, and most people are advised not to buy them, although you can use it to do speculations and or immunize hedging against risk. Way too expensive. Instead, we sell them, and that's if you own the underlying stock, and that's called a covered call. Level 1 trading, approved for all accounts, highly recommended. But you do give up the potential for a future capital gain, instead receiving what's called the certainty equivalent. Options for the underlying security, they used to have a more arcane system. It's just the symbol itself, plus you choose an expiration date. Many, not all, are the day after the third Friday. Some are weekly, some are quarterly. And you designate whether it's a call or a put, C or P, and the so-called strike price, the exercise price at which you want to buy or sell it. There's variations. But don't fret. You can look up instead, if you're looking at options, what's called a chain, and that will just merely give you all the various choices, and you can tap on the one you might prefer. Highly recommended are selling longer term, out-of-the-money calls on underlying securities. Options have strikingly peculiar differences in regard to how they trade. They trade in units of 100 of the underlying stock, so you multiply times the option price 100 to get the equivalent. They usually trade in nickels below $3, dimes above $3, but for those ETFs, those are mutual funds trading as stocks, they often trade in pennies than nickels. You have same-day settlement, and it's entirely 100% cash. And you can use those limit and stop orders. Let's move on to mutual funds. Mutual funds do not trade during the day. You cannot place a limit or a stop. They trade at the closing end of closing day price, which means you're a price taker regardless. Because you don't know the closing price, you sell in units of 1,000ths because you don't know that price, and you buy them in pennies, not knowing the units because you don't know it because it's the end of the day. The price is 1-to-1. There is 1-day settlement. These take 5-letter codes, and they end in an X, and if they happen to be money markets, they end in XX. Margin is available, usually 50%. Bonds are a debt instrument, and two major types are corporates, often, not always, in $1,000 face values, but trading as percentage points of 100, and government bonds, often, not always, in 10,000s, and again, trading in percentage points of 100. A legacy from the days of pieces of 8 and the pirates is still they trade in, respectively, 8ths and 30-seconds. That means the price, respectively, for a $1,000 corporate is times 10 that 100 price, and times 100 for the bonds that trade in $10,000. By the way, that amount is so large they actually have something called a basis point. That's 1% of 1%. Which in that $10,000 bond amounts to just $1. And you can borrow on these. You can actually do as little as 35% down, and you can use those stop and limit trading orders. The actual trading procedures are as follows. You choose one from each column. Notice the fifth one is optional. That's an optional restriction. And you start either with an open or a close. Open creates a new account. Close finds an existing ledger, so to speak. You either buy or sell. The buy or sell must be the opposite of the open or close, which is to say if you're going long, price rising hopefully, you open with a buy, close with a sell. Shorting is the other way around. You open with a sell, hoping the price falls, closing with a buy. You next choose a specified price. You can have a market order. That means you'll just take whatever or give whatever is out there. You'll be getting the lowest ask price to sell if you're buying, and you'll get the highest bid price if you're selling with a market order. However, you can override it by having a limit order, setting it below to buy, above to sell. A stop's the other way around. A stop order is executing a market order whenever it hits a triggered price, which for a stop order is typically above to buy, getting in on the action, so to speak, or a stop order to sell if the price falls, getting out of a bad situation. There's others out there like fill or kill, meaning for rarely traded, either it's right there or not, and execute on close. That's what happens with those mutual funds. The next choice is your timing. There's a day order, means it automatically cancels if unfilled by the next day, and GTC, good till canceled. It used to be standard in the industry that it was for 60 days, 2 months, but now a typical standard is it goes a half year, about 180 days. That means you leave it in there if it's unexecuted. The last is an optional restriction that applies to quantities, and that's the amount, noting the amount in the case of bonds is dollar value of the face. This is not as used as much as it was before because trading commissions have become de minimis. And in the case of many favored ones like ETFs, you can probably do them for almost nothing. But still, there are rules. If you want to buy the entire amount in a whole amount in the same day, it can be partially filled at different amounts at different prices, if you will. It's called all or none. You can also have a minimum that's less than the entire amount. And if you want to do the entire amount, it has to be all or none. Well, nominally, you'd expect to have limit orders at a better price or stop orders at a worse price. You can actually combine them, and you can actually override the intention. You might want to do a combined stop and limit if you want to go both ways, so to speak. On the other hand, you can also have a stop and limit that are contrary to their normal usage, and that is you just want to be sure. You could have a limit order that is not on the like side to buy, meaning below, or the like side to sell above. It means I just want to be sure, especially volatile markets with Dr. C Invests. Bye.